Hey everyone, welcome back to the Investing Iguana. Today, let's dive into a juicy one. Elite UK REIT's latest bounce and why Singapore income hunters are watching it closely. You know the problem. Most of us want a safe growing stream for our CPF or SRS, not another roller coaster ride. For a while, Elite UK REIT looked anything but safe. Brexit pains, UK budget tightening, and rising interest rates shrank their payouts, and confidence tanked. But in 2024, they flipped the script. Distributions jumped 10%, debt dropped, and they're looking fit for fresh growth. So, what's changed and can it last? That's what you'll get today. By the end, you'll know whether Elite UK REIT is genuinely back on track or just enjoying a lucky break, plus practical tips for fitting it into your SG portfolio if it makes sense. This script is adapted from my latest in-depth Substack deep dive. I'm Iggy, a former buy-side investor in REITs and global income plays, now helping Singaporeans make sense of markets with plain English, hands-on frameworks, and a sharp focus on local policies. Here's what we'll cover: Elite UK REIT's core business and income story, the 3 factors powering its comeback, 3 big red flags still looming, the triggers investors must watch, my Iggy's take for SG income portfolios, and what action steps you can consider next. Ready? Let's go. First, what makes Elite UK REIT, MXNU on the SGX different? Unlike your standard S-REIT, it owns 150 commercial sites in the UK with an incredible 2% of rental income from one client. The UK government's Department for Work and Pensions, the folks behind Britain's job centre offices. In the last year, their distributable income rose 5.8%. And DPU, distribution per unit, shot up 10% to 1.54 pence. That's not just recovery, but growth after a tough stretch. Analysts said revenue growth was tiny, only 0.5%, but it was smart cost control and refinancing that lifted the bottom line. For CPF and SRS users, Elite UK REIT can be bought under Singapore rules, so it's practical for that tax-advantaged overseas property slot. It's trading below book value at 0.8 times and yields almost 9%. That's a hefty paycheck, but the discount shows the market is worried, mainly about lease renewals and debt. Let's start with safety. Elite now has a net gearing ratio of 40.7%, its lowest in over 2 years. How? They sold off non-core assets at solid prices. Think healthy premiums, not fire sales. The extra cash trimmed down their debt before those nasty interest rate hikes could bite. Why does this matter for Singapore? MS caps S-REIT gearing at 50%. If you cut your risk early, the market rewards you before things get ugly. Lower debt means smaller interest bills, about GBP 2 million saved per year, which mostly goes straight into your pocket as a unit holder. Tighter capital management lowers refinancing risk and gives room for gradual organic growth. Singapore investors win when REITs de-risk before they're forced to. Here's the magic ingredient. With 92% of income from the UK government, cash flows are almost bulletproof. These job centre leases get paid whether the political winds shift or not. Government checks never bounce. Even post-Brexit, amid chaos, rents always landed. For CPF or SRS where you need certainty, this matters. Sovereign tenants let REITs borrow cheaper and pay more. It's rare anywhere, which is why these kinds of deals are so prized for Singapore portfolios. Elite UK REIT isn't just collecting rent. This year, they've inked deals to convert old offices into a 168-bed student residence in Dundee. Expected yield? About 7%, better than most passive options. And at Peel Park, after securing new power rights, valuations shot up 36% thanks to future data center potential. Smart repositioning can diversify income, cut government dependency, and build a new growth story. If execution holds up, development pipelines mean growth should get more consistent and less lumpy as new projects come online. Quick recap here. Lower debt, government money, and smart upgrades have put Elite UK REIT on a firmer footing. But there are still 3 big red flags. Now for the risk. When 92% of your rent comes from one master tenant, if they walk, you're toast. The average WALE, that's how long leases last, is just 2.9 years, most expiring in 2028. If the UK cuts the DWP's property needs, rental risk jumps. The bulk of income expires in 2028. This is unusual for S-REITs, and means Singapore investors need laser focus on renewal talks in the next couple of years. Elite has a high payout ratio. 95% of profits go out to holders, which means little buffer for shocks. The interest coverage ratio is a slim 2.4 times. About 64% of its borrowings are fixed, so a chunk still floats. Every 1 point bump in rates could dent distributions by 12%. Singapore policy values REIT stability. When coverage thins this much, jittery markets can punish the stock if global rates jump unexpectedly. Most properties are in UK regions, not London, often single use. If DWP bails, finding replacements is tough. Growth is sluggish. Revenue rose only 0.5% recently. Even with asset upgrades underway, Elite looks like a no-frills income bond. Great if the yield lasts, boring if you want upside. In Singapore, when you compare to REITs that offer actual capital growth, Elite feels a lot like a cold, hard holding pen for income, unless its growth picks up. So what could change minds? For better or worse? Lease renewal clarity. If DWP extends past 2028, the whole risk mood shifts, possibly sparking a rally. Asset recycling. Completing Peel Park type deals higher than book value proves the model and strengthens the balance sheet. Interest rates. A UK rate cut could lift distributions, as a big chunk of borrowing would benefit right away. Any sign the DWP plans to shrink, gearing above 45% from losses or poor refinancing, or occupancy dropping below 90%, all would spook markets. For CPF and SRS planners, these triggers control whether Elite is a steady income ladder or a stalling story. Here's my honest view. Elite UK REIT is back on solid footing. Growth has resumed, and the government lease is a rare local gem. But the renewal cliff in 2028 is real. I'm keeping it as a hold. Who should consider this? Income-focused portfolios, especially SRS, where steady, foreign income, and tax breaks matter. Its discount to book, now about 0.8 times, makes sense for medium-sized positions, not all-in bets. GBP swings add some spice, so size accordingly. The sweet spot for buys is GBP 0.35 to 0.37, unless and until DWP signs a new lease. Watch the three signals: DPU trends, asset pipeline follow-through, and lease news this October. Track DPU, gearing, and lease progress. Build size slowly. Don't chase yield blindly. To all CPF and SRS planners, this is a rare play for yield and managed risk, but don't ignore the renewal cliff. Every basis point matters. Let's tie it together. Elite UK REIT gives you rare exposure to UK sovereign rents and offers juicy yield. Safety steps are working, but the real verdict hangs on what the DWP does in 2028 and how well management can build new growth streams. For now, it earns a spot in the mid-weights, not as a foundational core. You can take these lessons into your SG investing journey and use them to get the most out of your CPF and SRS for the long run. If this was helpful, drop a like, share with your investing group, and subscribe so you never miss deep dives like this. For all the detailed charts, tables, and the written playbook, check the Substack link. Membership supports more of this content. And if you want a related deep dive, check out my analysis on Singapore yield REITs with global exposure. It makes a great next watch. See you there, and happy investing.